First conversation on the show today we have lined up for you is with All Cargo Logistics. The company witnessed weak operational performance in its June quarter. Profitability was impacted by forex loss and overall revenues were fairly subdued as well. Not unperturbed out here by this because the street was already prepared for that. The stock is down 5%, but remember Ravi Jakhar, who's the Director, Strategy and Group CFO, had told us earlier that the next couple of quarters would be subdued given the sort of problems that we are seeing internationally. Ravi, thank you so much for joining in. Now that the next couple of quarters have been subdued as you had promised a couple of quarters ago, do you see signs of improvement? If yes, then what's the kind of volume growth you are likely to see in both your domestic and international business? And if you could break that up into less than container load and full container load volumes for this year?
Yeah, thanks. It's always a pleasure to be on your show. And, talking about the business performance, we have two parts to it, the domestic side and the international side. On the domestic side, there are no problems on the macroeconomic front. The country has been doing well. The trade has been going up. And as an outcome of that, if you look at our numbers closely, we have reported a 50% increase in revenue year on year for our contract logistics business, and which is also translated into almost 30% increase year on year in the EBITDA. For the contract logistics business. Express business has also seen about 18% increase in EBITDA over the last quarter. So on the domestic side, businesses have a good momentum. And particularly on the express logistics, I would say we are seeing that the business is picking up traction now. We had kind of changed the management team about a quarter or maybe about 4 months ago. And we are seeing a good outcome of that. In the months to follow, you would see that positive momentum reflect in the revenue growth as well, which has been kind of muted if you see the last 2-3 quarters. So contract logistics business has been doing fantastic throughout last few years and remains on the same trend. Express logistics also picking steam. On the international business side, while the company-specific initiatives have all been good, the macroeconomic environment, as I indicated, has been quite challenging. Now, if we look at the coming quarter, this is a quarter which leads to festive demand. People are shopping for Christmas, and before they start shopping, inventories are stocked up. So as an outcome of that, you would see a stronger quarter, July to September. But I would say that, even a stronger performance in July to September does not necessarily warrant a continued momentum. For the continued momentum, we need the geopolitical instability, the entire tariff conversations to stabilize. And that's something which we would know in the coming 2-3 months. We have these 90-day and 60-day deadlines with various countries. So I would say, in short, the next quarter is going to be good for the international supply chain, primarily driven by the festive demand. You could see up to 8 to 10% higher volumes quarter on quarter, which would significantly impact the profits as well. But for that momentum to sustain and profits to really grow, we would need to see more certainty on the global geopolitical environment and the whole, tariff discussions.
Yes, this entire tariff tantrum has put the entire globe into a bit of a tizzy, so it becomes a little bit difficult. But you mentioned that number 8 to 10%. That's the volume growth you're likely to see in both LCL as well as FCL. Is that the number you've given us?
Yes, that's the broad number for this quarter.
That's quarter on quarter for the second quarter, right?
Yeah, that's right. Yeah,
and
quarter over June quarter.
For the year, what should it look like then?
Like I said, in the current environment, we have seen weekly changes. There was a week in which, for 2 consecutive weeks, the China-US trade dropped by 80%. The next week, which was up 3 times, right? We have seen in the recent times our Brazil to US trade had, significant downtrend. So, the patterns are so volatile, it is difficult to predict beyond weeks. But as of now, as we look into, July and August and bit into September demand as well, these 3 months looks good. And therefore, like I said, we should see an 8 to 10% momentum on the volume uptick on the back of the festive demand.
Right. You have near-term views, but nothing to do with the long-term because uncertainty is still underway right now. What about margins? EBITDA ex Forex in your international supply chain division was down from 2.5% to 1.6%. It's a business where you anyway have wafer-thin margins. And on top of that, there is, the Forex element, there is this international geopolitical uncertainty, etc. What is a sustainable margin run rate that we can expect in a business like this?
Yeah, so as far as the Forex part is concerned, that is notional. Let me explain to you very quickly. What happens is that, we have our main global holding company in Belgium, which reports in euro, and it gives intercompany loans in US dollars. And they need to be valued, quarter on quarter because of the accounting standards. Now, if you see the long term, over the last 5 years, euro to USD has only changed by like 1.8 or 2%. But this was an extreme quarter where it changed by almost 9%. At the same time, we're also reviewing if we can change some of the accounting policies to eliminate these notional gains or losses because, they create unnecessary fluctuations in the reported earnings. So we're also evaluating that. Having said that, from a business standpoint, you may recall that our gross profits are largely dependent on the volumes. And if you see the recent trends, our actually gross profits have gone up. Margins may not be the real indicator because revenue may go up or down based on the freight rates. But if you look at even this quarter, the margins have actually gone up. The gross profit has actually gone up. And that is not driven necessarily by the business performance. A part of that is also because our local charges that we earn in European countries have also gone up as the euro became stronger. But corresponding to that, the staff costs and the administrative costs in Europe also went up. So you see slightly higher gross profit than what should have been normally reported. You see slightly higher SG&A costs, and therefore the impact on the EBITDA from the euro perspective is neutral. There have been some, variable annual pay outs, etc. But from a long-term perspective, I believe that we can, look at 6 to 8% growth in volumes, which should compound into an equal growth in gross profit. That's what our estimation is based on assuming some settlement of the whole tariff debate and the trade normalizing a bit. And with that, translating into GP, SG&A remaining flat, we believe that could have a significant operating leverage on the profits. And that's what is the broad strategy we are working on, trying to retain the costs at the current levels. There could be some one-off movements here or there on account of annual payouts, but largely, I would say we're not focused on quarter to quarter at this point in time. It could still be a couple of quarters of reorganizing, outsourcing, trying to see how we can rebalance our cost structures. But in the long term, if I look at the full year 2026, and we operate January to December on the international business, I would say we're reasonably confident that we are in control on the cost side, and some momentum on the macroeconomic environment should put us in the right spot. And on the domestic side, like I said, the business is already performing well.
All right, take that point, Ravi. Thank you so much for joining in. Wish you good luck. Hope to speak to you once things are better. But for now, the near-term visibility that you have is 8 to 10% volume growth in the second quarter. Take a short